Hi everyone. See you streaming in. Karibuni sana. Give it a few seconds and we get started. Good to see you. Good to see you. Happy New Year. I hope it's not too late to say happy, but we've not, this is our first episode for knowledge sharing. So I think it's in order to say Happy New Year right about now. Yeah, we see you. See you coming in. Karibuni sana. Good to see you. Those joining us on LinkedIn, those joining us on YouTube, those joining us on X. Welcome to our episode of Knowledge Sharing series by ESAC. Today, it is in collaboration with Amana. They'll be talking to us about their products and what they do, and telling us more about what they're doing and how they're changing the sector. Yes, we see you. We see you joining in. Karibuni sana. Karibuni sana. Just a quick reminder, we are live on X, we are live on LinkedIn, we are live on YouTube as well. Please share your comments, share your questions. We'll be happy to engage and answer them at the end of the conversation today. Again, this is ESAC, another episode of KSS. Our mission here is to demystify the sector through conversations. And that is what we'll continue to do, bringing you experts from around the world, and engaging conversations that not only shape but also inform policy and the way forward. Karibuni sana. Again, our today's episode, Unlocking Local Capital for Power Projects, is in collaboration with Amana Guarantee, who are part of this conversation. They'll be talking to us more about that. And we look forward to an engaging session with you. Type in your comments, type in your questions in the comment section, whichever platform that you're watching us from. We'll be glad to answer and engage with you as we continue with this dialogue. Karibuni sana, karibuni sana. For more information, we'll be sharing our details as we continue with the episode. You can reach us through either phone call or email. We'll be glad to continue this off the live session. I would like to stop it there and hand over the session to our moderator for today, who is none other than Agnes Agina. She'll be telling us more about the manner and what she has in store for us today. She'll lead the conversation with our experts. Karibu sana, Agnes.
Thank
Over
you
to
very
you.
much. Thank you very much. Good evening, everyone, and welcome to the series where we will talk about unlocking local capital for power projects. So, to start, my name is Agnes Agina. I'm the Legal and Compliance Manager at Tamana, and I look forward to taking you through this session together with the experts that are on this call so we can be able to highlight a couple of things that speak to the topic. Before we start on the conversation, what we will do is have the experts introduce themselves, and we will start with Willie, then Florence, and then Andrew will come after.
Thank you, Agnes. Yes, my name's Willie Reri. I'm an infrastructure professional, having worked in energy most of the last 10 or so years. By background, I've had stints with GE Capital, and currently with a group called Osprey Renewables, and happy to be here. Thank you.
Good evening, everybody. Thank you, Agnes. I've been looking forward to the conversations. My name is Florence Wambugu. I am in the energy and infrastructure space. I've been in private and public sector in the energy space, where with my background in civil and then moving on to energy, and I'm currently a consultant in the space. Thank you.
All right, thank you very much. Thanks, Agnes. So my name is Andrew Lumumba. Also one of the experts that have been asked to speak on this topic today. My background is primarily in civil engineering, but I also have a bit of experience in finance, and my job is to find and assess transactions that are bankable within East Africa. So it's great to be part of this.
Great. Thank you, everyone. So today our topic, as I had introduced it before, is unlocking local capital for power projects. So unlocking local capital for power projects is not just about financing. It's about market maturity and confidence and how we assess and allocate the risks that are attached to the projects. Kenya has a diverse pool of local capital, yet too often when financing power infrastructure projects, we look outwards before we look inwards. So we'll delve into the conversation to just understand what is standing between the local capital and the power projects that are the members of ESAC usually look or develop. Getting into the first question, and this will go to Willie and Florence. From a developer's perspective, why has local capital historically been avoided or historically avoided power projects, and what has changed?
Florence, if I may. Okay, thank you. No, thanks, Agnes, for the question. I think it's a topical question and it's timely. Why has local capital historically avoided power projects? I think I'll underline the word avoid and perhaps try and unpack that a little bit. I think it's a factor of many things. If we use Kenya as an example and Sub-Saharan Africa, by extension, I think historically, power has been the domain of governments, and perhaps maybe 20 or so years ago, particularly in Kenya, we got the private sector, coming in to invest in this space. Power projects by nature are capital intensive. They do require a considerable amount of funding. They do take a long time to develop. They do require, various structures which has attracted, I would say, foreign capital, particularly the development finance institutions, the DFIs, who I would say over the years have had that mandate to go and participate in this particular space. In many cases, to support governments to foster growth in this area. That foreign capital has come with its own, I would say, structures. So in as an example, you'll find a lot of the capital is hard currency, whether it's dollars or euros. The structuring around that kind of money has had a direction where the power purchase agreements, obviously hard currency denominated. And what that means is also from a kind of cost of capital, some of these players have come with very low cost capital, which is also long dated. We've seen examples of where DFIs have come in and lent for, say, 15 to 17 years. Now, because this has been in the development space, it more or less has, crowded out local capital, which obviously, as we know, may not be able to provide that kind of cost. The costs tend to be higher. The costs tend to be attached to the sovereign credit positions. So they're not competitive against, DFIs, making them non-competitive. In addition to the kind of long tenors that we're talking about. So I think so. It's not a case of avoidance. I think it's a case of historical. There's some history to unpack, which has led to us seeing more foreign players in this particular space, and I'm talking both debt and equity to some extent. So that's changing. Obviously, we're seeing the sector evolving. We're seeing some of those local players, getting a bit more interested in this particular space. I think there's more transactions and opportunities. Therefore, I think with time we'll start seeing more participation in this particular sector from the local players, and the drivers will be. There's a lot of pressure for local capital not to traditionally put their money in government paper, T-bills, bonds, which have done exceptionally well over the years. But as those rates come down, there's a reason for this capital to diversify and look for, I would say, well-structured, mature assets, which actually power projects do provide. And if they look in that area, I think they'll see very good projects with very good returns, which are favorable. So yeah, I think I'll pause there with those few remarks. Thank you.
Thanks, Willie. Just on the backdrop of that, and this is a very timely conversation, especially with the news on the uplifting of the moratorium on the PPAs. So unlocking the local capital, and now that the PPA is denominated in a different currency, it will definitely see a different ball game being played. We have our peak demands currently are very high against what we have. Around, I think, December, we had about 2,400 peak against a previous month of about 2,418. So what we are seeing is we do have a pipeline of projects. We do have projects that are ready for development, but are they structurally ready? What are we saying now? What are the conversations we're going to have? And as Willie has rightfully put it, previously we had a lot of DFIs coming in, and the cost of capital was much less, especially with the interest rates. What we were seeing previously were dollar-denominated PPAs. And with the shift that we have now, we will have a lot more players in the market. So I wouldn't say it's avoidance, especially when it comes to like capital assets, which, if I would put it this way, that despite the asset having all the elements being imported, so we would still need to consider the foreign currency. However, there are OPEX items that can be taken in consideration. So with that in mind, they are different. There is a convergence of everything that's happening today, especially with the development and the uplifting of the moratorium. Thanks, Agnes.
Thanks, Florence and Willie. It's interesting that you've spoken about the uplifting of the moratorium. And I guess this is something I should ask all the panelists and the experts here, given that we also have an engineer who has turned to become a financial expert. So in the context of the lifted PPA moratorium, how do we ensure that the next generation of power projects are structured in a way that attracts long-term local capital, particularly in local currency, while maintaining affordability and bankability? This is to all of you. So perhaps roll a die and choose who starts first.
Okay, I think I can go next. So essentially, how do we make sure that we get adequate local capital to fund these kind of projects? Well, we have to essentially balance the financial market. We have the supply side and the demand side. So on the supply side, and I think Willie touched on this a bit, we need to have pools of liquidity that have the mandate to invest in these kind of instruments. You would find that most of the pools of liquidity held either by institutional investors or by the banking sector or even by retail investors was or has been very, I'd put quote unquote, risk adverse. And the risk there is not in my view, it's not a real risk, but it's a perception of risk that makes these people have, a sort of investment inertia that needs to be overcome. So having pools of liquidity that have a clear mandate to invest in these kind of opportunities that is, locally managed and has been put together locally would go a long way in improving the chances of getting these transactions funded by local capital. And then on the demand side, you have also issues around bankability. So at least I know from trying to get these transactions across East Africa, and in this case, we are concentrating on Kenya. It has proven it's possible, but you have to do quite a bit as an investor to get these projects to be bankable. And it would be great if we could have more sensitization on what it takes to make a project bankable. This would give us a large pipeline of bankable projects that could then be funded by these mandated institutions. So those two, I think, are the two levers that we need to move to be able to ensure that these projects get funded by local capital. And if we do, again, points raised by William and by Florence, we hope to see then that these projects would not necessarily have to then be carried onto government's balance sheet alone, and risk premiums would fall because government would not crowd out private capital. Private capital needs rather, and a lot could happen. So yeah, and as you mentioned, Agnes, the lifting of the moratorium gives us a chance to get this done. So let's see how this goes, right? But I'm looking forward to hear what my fellow panelists would say.
Yeah, no, thanks, Andrew. I'll add to what you're saying. I think for me as well, in addition to what you've said, it's worthwhile, having a lot of these local institutions participate in what I would call the secondary market. Secondary market is whereby the early projects, the projects that were built, developed, and have been in operation for a few years, a lot of those same DFIs are their mandate is not to own and operate and stay in until the PPA expires. A lot of them, what they tend to do is they will sell off their positions, whether it's on the debt side or equity side, and move on and do other similar difficult deals in other jurisdictions, right? And I think for me, there's a space there for local capital to get interested in such assets. Most of them, if not all, have been de-risked. Have been operating for a few years. There's this track record both on the operation side when we talk technology. There's track record on the financial side when we talk payments, return, credit. So there's kind of that history, and a lot of the kind of institutional investors we're looking at perhaps more yield looking rather than I would say equity type returns. So you find that such assets would be very interesting for them, and they can build kind of expertise around that secondary space, such that as new projects come through, they're very conversant with this space. Yeah, and there's a reason why actually, when you look at the so-called foreign investors, if you unpack who's behind them, it's actually institutional investors. It's pension funds from other countries, right? Who are comfortable. A Canadian pension fund is comfortable taking risk in a power project in Kenya. There's a reason why they're comfortable. Perhaps it's years and years and years of doing this, to the extent that they understand the structures, they get comfortable with the off takers, and yeah, I think it's all about that kind of exposure. So for me, that's the added thing which I would say is encouraging. It's shifting because we're in that second life of projects in operation, which was not the case, I would say, 5-10 years ago.
Florence?
Thank you, Agnes, and thank you, Willie and Andrew. Yes, I am aligned to what Willie has gone through and what Andrew is saying. What we are seeing today, even with the technical expertise that's available, while before it might not have been available even from the local perspective, we do have now more project finance experts who are able to develop the market now, even from a local perspective. So this is the current, at the current time, it's more feasible and well, with the experience that we have borrowed from other projects that have been running for a long time, there are those structural adjustments that need to be made. And coming on the backdrop, I will not talk about Damana because of the guarantees and the partial guarantees that you might be offering. But our market is more mature, and we have locally available funds. But we do appreciate the debt matrix that we are going through and the balance sheet that we do have. So this is an opportune time to tap into the local market and just borrow from what has been happening. And as I think Willie has said just now, a couple of minutes ago, what we are saying is there Canadian, for example, Canadian pension funds or any other foreign funds. We do have pension funds that have started, but we do also appreciate the limitation in the caps that they are able to invest in, which is capped at about 10% on the asset. But as we said, there are some structural adjustments that need to happen to make these projects bankable. Thank you.
Thanks, everyone. Quite informative, and I've picked quite a bit of things. But this would be directed to Andrew, and any of the other panelists can be able to jump in if you have additional things to state around the structure. So, Andrew, how can power projects be structured with a credit guarantee for longer tenure to improve bankability and, most importantly, affordability?
Thank you. Thank you very much, Agnes. And just to pick on that last point that Florence was talking about, it's about the structure. It's about the transaction structure. So more often than not, when an entity is looking for funding, they believe, at least from the developer or the executor point of view, more often than not, you'd find that they believe, I have a project, it seems viable to me, I have the ability to execute. So why are these people not able to see my ability? But it all falls down to the structure. So at a fundamental level, guarantees work through risk transfer. What they do is they transfer risk from entities developing these projects to institutions that have stronger balance sheets, right? And are able to manage risks more effectively. So, for example, when a lender knows that a well-capitalized guarantor is behind, let's say, a run-of-the-river hydroelectric project, they will be more incentivized to take that risk to support that institution. And while guarantees do not defray the inherent risks of the transaction, they give these entities comfort to make sure that the kind of money that they're providing to these projects is suitable or suit for purpose. So guarantees enable people to get longer tenors. So as a lender, if I am not sure what will happen with water levels in the next 20 years or the next 15 years, I may not be able to lend to that project developer. But if there's a guarantor willing to step in and, say, essentially, I will cover this person in the event that they're not able to make their timely payment of principal and interest, then as a lender, I have no logical reason to refuse to give that facility to that developer. So that's how at least the guarantees are used to be able to extend tenor. But when it comes to pricing, what we normally say is if banks and investors and institutional investors and retail investors and the whole suite of capital holders, the people with the money, if they're honest with themselves and they're willing to price appropriately, to price to risk, then if they are given a guarantee that is rated AAA or AA, vis-a-vis an institution that was probably having a credit profile of about B minus, then ideally they should actually reduce the costs or reduce the financing premium that they would charge on these transactions. So a guarantee can be used both to reduce costs, to increase tenor, but essentially it's just to transfer the risk to an institution that the lenders feel will be able to will be able to make good on any obligations that were required under the facility agreement. And so the main purpose of a guarantee is just to stimulate the market, essentially, right? And we hope to see that after some time, these lenders are able to go and do these transactions on their own without a guarantee. Yeah. But again, looking forward to hearing what my other fellow panelists would have to say.
Thanks, Andrew. So it appears we're talking about the pricing to risk and not pricing to the perceived risk. Any additions from William Florence? How do we structure these projects to attract the local capital? In addition to what Andrew may have said.
Yeah, I think Andrew has covered one of the, I would say, the biggest risks. That's payment risk in my view. And again, that payment risk, is it perception? I was researching Kenya Power before the session, and who actually they borrow. They actually borrow from local banks. They've got huge positions. If I recall the numbers, 16 billion or something shillings of corporate credit facilities. So they're known in the local space. The credit risk teams that look at Kenya Power as an entity, I think, know how to assess them. I think the local players always have an advantage because they're here. They understand collections, who pays, who doesn't pay on time, etc. Right? And they still form a view and say, here's some capital, and maybe the tenor is more short term than what we talk about in project finance, right? The guarantees, however, are helpful because you're talking about you're one step removed from, for example, the utility as an entity. You're looking at an asset level, so there's a bit of compounding risk around. First and foremost, that project needs to operate and return capital. But then there's a dependence on the utility or the off-taker on actually making good on their obligations as well. So the guarantee certainly does help with that regard in terms of structuring. Yeah, thank you.
Great, thank you. We'll get into the next question. So this goes to all of the panelists, and after this, you can also give a parting shot of what you want the audience to remember you by, or what you want the audience to think about as we move away from this conversation. If we remove the FX risk entirely, would local capital still be sufficient? Are we still facing deeper structural constraints in regards to the development of power projects? Perhaps we can start with Florence now.
Thank you. That's a very loaded statement. Let me first start with a caveat. Well, again, it's the structuring, and we will not necessarily remove the bankability when it comes to the forex. It's still in question, especially as I think Andrew had alluded to earlier, the supply and the demand side. There'll always be the forex, the FX risk, especially when it comes to the local capital. But there's a question of hybridization, but I think we can discuss that at a later time. And again, on the cap, in regard to that, well, I don't see, in my opinion, I don't think if we did justify the forex risk, it will make, it's an answer to all. There are many cogs in the wheel that need to be addressed, such that we are still talking about bankability, because it's not just an element of the FX in the whole project. There are a lot of other issues that come into play. Yeah. Thank you. Thank you.
Andrew?
Thank you very much. I think Florence hit the nail on the head. It's about structure. So short answer, in a world where we could do away with FX risk, where local, if you were to use local capital without FX risk, that would mean probably local currency. In a world where we would have transactions denominated in local currency fully in the energy sector completely, then yes, local capital definitely would be sufficient for many of the power projects, probably all of them. Kenya alone has trillions and trillions of shillings lying idle or probably being invested into sovereign securities that could be easily diverted into these infrastructure projects, and probably they would get a decent return. Right? And we have many institutions that would really love to get the opportunity to do this. They just need to be incentivized and probably guided in the right way. So the real challenge is not availability of capital. It's how we package the projects and how we connect investors to the opportunity. Right? So we need better project preparation, cleaner investment structures. Essentially, once projects are well structured and risks are clearly understood, I am positive that local capital will be capable of supporting this sector.
Yeah. No, let me add to the conversation. Yeah, FX risk. I mean, it depends on actually which side you're on. If I translate it to kind of what I've seen in the sector of the years, you tend to find that most African sovereign currencies depreciate over time. So the FX risk really, you're actually hedging. If you deploy a hard currency into a project as a lender investor, you're a bit hedged from that devaluation side. So the risk from the local capital perspective, I think it's you can look at that a bit differently from the devaluation perspective, right? And maybe the question here is there sufficient local capital to effectively close the gap in the power infrastructure that's required in these countries? Again, a couple of numbers from some sources that I've looked at, and Andrew, you said it. There's trillions of dollars available in domestic capital. If you look at pension funds, commercial banks, then the stock exchange, you're talking well over 10 to 13 trillion shillings. Call that $100 billion. That's sitting in various places. Now, regulation, Florence, you mentioned it, 10% of that can be deployed into alternative investments. Let's assume maybe a fraction of that goes to the power sector. You're at $5 billion, right? Now, what's the need on power infrastructure? Again, this is publicly available. To do power and grid and transmission infrastructure, you're talking, call it 30 billion over the next 10 years, right? So however we cut and dice this, I think that local capital can play a significant part, but there'll still be a need to have some kind of blended finance, some foreign capital, some guarantees in this particular space, right? So for me, my view is exactly that. It's good to crowd in the local capital, but I think this should be done with other forms of capital, because the need is so big that not one space can actually plug that particular gap. Thank you.
Thank you, everyone. It's quite interesting to hear your views on that last question. We're about to transition into the Q&A session. So is there any additional parting shot that you might have, or do we transition straight into it? I will take silence for us transitioning. So, okay, we have the first question from Andrew Adwera. He asks, in discussing risk mitigation, a question could be if there is adequate guarantees available to cover potential defaults. Perhaps the best person to start with that response is Andrew, and then we can hear everyone else on the panel.
Thank you. The short answer is yes. There are guarantees available in the market, and they are across the region. There are very many providers of these guarantees. So you would find many institutions, development finance institutions, multilateral agencies, and others who offer specific types of credit enhancements or mitigation products, like specific political risk insurers, are available across the region, and they are able to help you on projects in Kenya. However, the real issue is I think not whether. So for me, from a perspective of whether do we have enough guarantee and guarantee capacity, I think we do. The issues that I see are, do we have enough viable projects that guarantees can support? But that's another matter altogether. But just to answer that question briefly, yes, there are very many providers, quite a number of providers. There are not very many, but quite a number of providers, and they have adequate capability, at least for now, to provide guarantees.
Willie, Florence? Any additions? I can repeat the question. In discussing risk mitigation, a question could be if there's adequate guarantees available to cover potential defaults.
I think for me, nothing to add up. And again, we know there's different products available in the market. PRIs from MIGA, Damana have a product, TD have a product. So I think there's plenty, and they cover different aspects of risk. But I do tend to agree with Andrew. It's you do need a quality pipeline of projects coming through, and the last step should be solving for perhaps one or two things, not 10 things, right?
Yes, I am aligned to what both Andrew and Willie have gone through. It is important to have these guarantees. I'm sure we have seen what has been happening in the market, even through the delays. But what we are saying is we need to get the ones that are addressing the particular need at that point, and what we are trying to safeguard, or the risk we're trying to mitigate against. I hope that addresses what we are.
Thanks, everyone. Yes. We'll get on to the next question. And perhaps I can just add a little bit of my view on that particular question. So risk mitigation is all about the person who's best suited to take up that risk. And in terms of a payment default, yes, a guarantee would be the best placed kind of mitigation for that risk, as well as whether there are enough in the market currently. But then also we also need to look at the support mechanisms that are available under the law and also under our jurisdiction. Moving on to the next question. There was a mention about local capital pools of liquidity that need a mandate to invest in energy infrastructure. What type of mandate do you think would help bring comfort to local investors? And perhaps Florence can speak to this because she alluded to the 10% and provide additional color on that, and then the rest of the panelists can join us.
Thanks. Thank you. We do appreciate there is a pool of money, but we also appreciate that there is a cap. So what we are seeking to address is the way the cap has been structured, and in regard to the particular asset, with a 10% cost, what we would need to look into or investigate further is how much more can they go. But there's also the element of safeguarding the monies that are present, even as you're progressing the different type of projects from the different types of pools. So what we are trying to say is that, well, there's the history, and there are different projects, and there are different phases of the projects where they are in. So with that in mind, we would take into consideration the phase of the project, whether it is the initial phase of the project, and then maybe structure accordingly. That's how I would address the question.
Yeah, let me add to that. I think I alluded to it. It depends on also the source of capital. Commercial banks will take a different view on infrastructure projects than pension funds. I think maybe they can take a bit more risk than a pension fund. So their mandates tend to also be structured very differently because while they're all regulated, some are more sensitive than others. So you might find that the retirement benefits authorities rules may be more stringent, whereas commercial banks might be a bit more willing to take different types of risks depending on where the project is in the life cycle. Yeah.
Yeah, and just to add on that, actually, um, when we talk about mandate, what we're talking about is clarity and alignment with investor risk appetites. So essentially, when you have an institution with a mandate to invest in infrastructure, they are very clear with their risk appetite with regard to tenor, with regard to the kind of taker profile that they're willing to accept. They are so when they are calibrating the risk levels on a transaction, they are able to move forward with more clarity than with an institution that has a very wide mandate. So a good example would be the National Infrastructure Fund that is about to be set up. Hopefully, it will be set up by the government. You'll have this fund that has the mandate to specifically look at infrastructure projects that, of course, would be priority for the government, but as well would be able to stimulate the economy. And having such a vehicle gives a clear mandate, clear rules upon which domestic capital can participate in these energy projects. So that's what I mean by clear mandate. I think there are institutions that have tried, but yeah, so we have currently majority of the institutions that are operating in this space have a very diverse mandate. So you require credit officers working in these institutions to be quote unquote financial supermen because they need to understand this and that and many other types of facilities that are offered within the financial market. So yeah, that's essentially what I meant when I said mandate. Yeah, thank you.
Thanks, Andrew. Sandra, I hope that answers your question. Moving on to the next question. The viewer says, great conversation. Technology is evolving every single day with new innovative equipment. How does it affect a local financier's decision making when it comes to the tech like e-mobility and battery storage? Andrew, perhaps this one is for you. Yeah.
Yeah, wow. So that's a very good question. Technology is evolving every day. When I look at battery technology right now, and when I look at e-mobility solutions around both two-wheeler, three-wheeler, and four-wheeler, and multi-wheeler vehicles, I think to myself, this person needs a 15-year facility to make this viable. In 15 years, would the battery technology look the same? It is very unlikely. So that is actually a very, very important thing when it comes to assessing the viability and the bankability of a transaction, especially in that space. That's how it affects it. How can you mitigate against it? You probably need capital that's willing to take higher risk. So trying to convince a pension fund who are known to be traditionally risk averse to take this kind of transaction would be difficult. You'd probably try to look for an institution that's willing to take a gamble with you and probably willing to be flexible with regard to term, tenor, and so on and so forth. And you may get a higher risk premium charged on this kind of facility because there is some uncertainty as to the future of the viability of the current technology that you're using. But do not give up hope. So there are many institutions that are closing capital today with large multilateral institutions in this space. So it's possible to structure something, but definitely the change in technology and the quick evolution of technology is a thing that is always kept top of mind.
Thanks, Andrew. Willie, you look like you want to say something.
Yes, I do. It's actually a very interesting question because when we are talking utility scale power plants, you find that you got to invest in technology that should last the course of time, 15, 20 years, if you're bringing in whether it's solar panels, turbines, etc. So the type of assessment on that type of technology tends to be where else has it been deployed? Is there any case studies, test studies, a lot of data points on how it's operating, supply chains, etc. And you kind of tend to get experts to help with that kind of review. But I think for fast moving technology, e-mobility batteries, I think that would absolutely require a different way of assessing it. My sense is also there's different pools of capital that is attracted to kind of this space, whether it's more VC type money, which is able to take a view on expiry of technology or obsolescence of technology pretty quickly. So there's just different ways of looking at it, but it's something worth looking at very carefully.
I agree with the panelists, and just with most type of technologies, well, there's the evolving part, and then there's the what we have had previously, old age, like when we are having the hydropowers and all this. However, with this, it's a new age, but with time it will catch up, and so there'll definitely be something, some local financier coming up. But for the present, it might be a little bit difficult, but it's just the entryway at this point. So with time, I do believe that it will catch on, and there will be solutions that will be readily available for this. It's just that it is still a little bit early, but I think it's a very good thing to proceed with. That's my view.
Wow, thank you all. So now we'll do your parting shots to the conversation, whatever you want the audience to think about, and then we will wrap up and hand back to Isaac. So sorry, I've just seen a question that has come in, and perhaps I can read it as you're thinking through your parting shot. Just curious whether there are any locally accessible project preparation facilities available to project sponsors in the energy space and on battery. Also, okay. I am also, Christy, understanding what institutions in power and energy space are doing from a curious. I think that I'm also curious to understand what institutions in the power and energy space are doing from a policy perspective, given that regulatory frameworks can often limit investments. What steps are being taken to enable the development and bankability of storage projects? So the question is more around if there are locally accessible project preparation facilities to support project sponsors in the energy space. So perhaps one person can take that. And then there's curiosity around what institutions, what policy and regulatory frameworks need to be rather tuned or tweaked to be able to support institutions in the power and energy space. and then what's happening to make the development to develop bankable storage projects in Kenya? Like, how do we enable that to happen?
Yeah, let me take a stab at it. Look, there is project preparation facilities in this space. One can research that through mostly again I think the DFIs. There's groups like IRENA who are in the energy space, a bit more international. There's there's different associations definitely out there who are looking for deals and offering preparation. Now, project preparation is also a factor of how advanced is a sponsor. There's usually kind of milestones that sponsors have to have achieved before they can access the next level of funding. A lot of it is permitting related, etc., etc. So that information, happy to provide some leads to whoever's asked that question separately. I'm not sure I'm in a position to answer the other questions on batteries and storage. I don't know if the other panelists are.
Andrew Florence, any insights?
So maybe I can just take a stab at the second part of the question, because Willie has done a very good job on the first part. So in terms of, so that the question is actually a two-parter. The first part is, what institutions in the power and energy space are doing from a policy perspective, given that regulatory frameworks can often limit investment. And the second part is, what steps are being taken to enable the development and bankability of storage projects. So beginning with the second question, which is a bit easier to answer. So there are many projects that are actually being developed to be able to have battery storage as part of the future generation mix, or energy mix, when it comes to grid energy provisions. For example, I know KenGen has been talking about executing grid scale battery storage project, and what steps are being taken towards that development. So there are a lot of feasibility studies being carried out, and I'm sure sooner or later they'll come up with a bankable project. And bankability essentially is about your project structure, how you ensure that adequate comfort is given to lenders that your project will operate, and the people meant to pay for it will pay for it and enjoy the service that the project provides. From a policy perspective, I think quite a bit needs to be done, and from a regulatory framework perspective, I know a lot of this will be, well, since the lifting of the moratorium, there's more incentives now for institutions working in the power and energy space to lobby more, to get certain policies that would benefit this sector to pass through. An example, though I don't know whether there's a lot of argument on the benefits of this, but an example would be having power purchase agreements that are partially hard currency and partially local currency, just to mitigate the FX risk on the off-taker side, which, let's use Kenya Power as a good example. And that would enable projects to become more bankable, and it gives the lender or the investor, whether it's equity or debt, or even grant comfort that this project is now viable because the off-taker has a better capacity to pay. So I think more will be seen as we go forward, but maybe we can touch base on this more in detail after this session as well. Yeah.
Thanks, Andrew. Thanks, Willie. In regard to the last part of the question, what steps are being taken to enable development and bankability of storage projects? So in regard to development, there is a lot going on around this. In regard to bankability, it's normally about the number and the tariff. So in that regard, there's a lot happening. I don't know whether you're alluding to a particular project, but when we talk about the bankability, it is whether it will be able to meet its return. So that becomes a price point for the whole, even when we take into consideration the tariff. I hope I've addressed that. Thank you.
Sorry, and as my colleagues were speaking, I think there's also a lot of information through the industry sectors. So ISAC actually that's convened this group should have a fair bit more information on regulatory aspects, policy around this space. And ISAC as an industry sector also does participate in lobbying for what makes sense on behalf of the sponsors, developers. So that's just another touch point. And that information should be available and can be shared.
Agreed with you fully, Willie. In terms of lobbying and participation in developing the regulatory space and the legal space, use your association. It helps quite a bit to get heard. It helps quite a bit to also come with a consolidated view. So ISAC is one of the good ways in which lobbying in the regulatory and the policy space can be done. We should now go to the parting shots. Ladies first.
So in regard to the question, unlocking local capital for power projects in Kenya, because we've lifted our moratorium, the ingredients are here. Liquidity in our banks, growing appetite for institutional investors, and new policy frameworks that permit the structures that we need. Question now we have is, do we have the courage to proceed? That would be my parting shot. Thank you.
Thanks, Florence. Andrew?
Thanks. I think it's along those lines. The capital exists, the local capital exists, the demand for power exists. What's missing? Our courage to develop bankable structures, right? So just ensure that we have clear risk allocation, predictable cash flows, and of course, discipline guarantees to facilitate locking or unlocking capital for these power projects that are soon to come through now that the moratorium has been lifted.
Thanks, Andrew. Winnie?
Apologies, there's a storm where I am. I hope you can hear me. I'll speak loudly. I think my parting shot is, I think it's exciting times and looking to work closely with those who have local capital on this journey and get into transactions, get into projects and close them.
Thank you, Willie. And my parting shot to everyone is thank you for coming. As we look to unlocking local capital, we need to think about the fact that it's not about replacing international capital. It is about strengthening the foundation of our own market. How do we strengthen the foundation of our own market? It's by aligning our regulatory system, aligning our legal system, the policy system, aligning the financiers who are there. So we have what it takes, and also the sponsors need to be aligned to the fact that this is something that needs to happen for the enablement of our entire ecosystem, just so that we can get to the next level. Because the next chapter of Kenya's power sector will not be defined by the megawatts installed, but how confidently domestic capital stands behind them. Thank you very much. I will hand back this to the ISAC team.
Thank you so much. Thank you so much, Agnes, for taking us through the 1 hour of unlocking local capital for power projects. Andrew, you did mention the transition from engineering to what you're currently practicing. Story for another day, maybe. Willie, good job, and thank you for the insights from a practical point of view, as well as a consultant. Florence, thank you so much for your input. I think the one thing I've taken away from this conversation before this, if I would have been asked, I would have responded like a typical Kenyan and said Nimbaya. But at least now, it's good to hear that considering the dynamic nature of the sector and how things are evolving, there's no one shoe fit all. I think the secret is in how you structure your projects, how bankable it is, and you're able to apply either if it's a DFI or local capital that is available to you. So thank you so much for your input. To our audience, if we can continue this conversation away from this live feed, I will share an email on our streams or whichever platform you are following us from. Then you can either reach out to us and we can connect you to the experts who are sitting in our panel today. Thank you so much. It's already raining for Willie. I don't know if you'll be able to leave. I suppose it's the same for most of us where we are at right now. So thank you so much for joining us. See you in our next episode next month, end of next month, and follow our socials for more updates on this. Good night.